then gets us into bonds. Okay, so probable long-term versus current, less than a year, greater than a year, pair of balance sheet, proper classification of short-term and long-term. Okay, so that's that. And then let's see what else they're going to do on 10. Characteristics of a bond, all these different par value, stated value types of issues. It's almost similar to like a common stock type nomenclature, but a little different in some cases. After tax cost of bond financing. Okay, so let's go over the bonds. Chapter 10, where am I at? Right here. Chapter 10. Let me close this up. And we go to chapter 10. Okay, bonds. Change how I'm sitting here for a second. So a bond is a liability, right? Unlike a stock, they're handled in a lot of the same way because they're a financial instrument, but a bond is a guaranteed amount that's owed back to the person providing the cash at a certain interest, a specified interest rate. Whereas stocks, you buy it, you may or may not get the money back. It all depends. You may or may not ever get a dividend. But so a bond gives you a surety on a guaranteed return. So let's look at some of the specifics. So par means that effectively the stated value, let's say it's $100,000 in this case, is what is being granted or being received, and you're issuing a bond for the same amount. So that's a par value type thing. This one suggests it's $100,000 at 8% for 2-year bonds, right? And it gives you the start and end date and the terms of when that interest is paid. So semi-annually. So this is when you first set it up at par value. It's pretty straightforward. You're setting up the payable and then receiving the cash, or receiving the cash and setting up the payable. I'm not sure why I always look at things a little bit backwards, but I guess I do. And then the first semi-annual payment, so it's 8%, so it should be $8,000 divided by 2, right? So you got your $4,000 as bond interest and then paid out in cash. Sometimes they'll set up as a payable and then send it out as cash, but this is a direct method. They're just paying it out and recognizing it at the same time. And then when it matures, it's just the opposite of this original entry, right? So the bond at par is then paid back in full, $100,000 comes out of cash, and it reduces the payable that's here. So in the end, this nets out to zero, right? On both sides. It's just a timing issue. You had cash in possession for a period of time, you paid out some interest, and then you're done. Now you do this every this entry happens 4 times, right? Because it's a 2-year bond. So June 30th, you're going to make this entry. December 31st, you'll make that entry of 2021. And in 2022, you'll make the same 2 entries because you're paying out effectively, was it $16,000 over that 2-year period of time. Now that's at par. So that's the most simplest version of the bonds. Any questions?
Do companies like Nike, I found that a weird example because do they really pay out bonds?
Yeah,
to
they'll
people?
issue bonds.
Oh, I didn't realize that.
There's government bonds, there's commercial bonds. So yeah, the larger companies, smaller companies, well, mid-sized companies might issue bonds in addition to government entities to raise some money for whatever project they're working on. Okay. All right. So then the question is, when a bond sells at a discount or a premium, and that always generally is determined based on what the actual interest rate is versus the contract rate. And that's what they're going to talk to you about here in this part, right? The contract rate in the prior, let's say, was at 8%. But if the market rate is higher or lower than that, then the bond will sell at a higher rate or at a lower rate. And it'll walk you through what that means. So in this case, if the contract rate is greater than the market rate, then the bond sells at a premium, because effectively people are willing to pay more for the bond because the contract rate is better than the market, right? So it commands a higher price. But if the contract rate is less than the market, then it's going to sell at a discount, because you can get a better rate if you go and just invest your money someplace else in the market,
Okay.
right? So contract rate greater, premium. Contract rate lesser than the market rate, then it's at a discount. So these two concepts effectively you need to understand pretty well. The market, contract to market at the same is going to be at par, because there's no difference, right? So you're not,
Mhm.
the market's not making an adjustment when they purchase it, whomever it happens to be, because there is no adjustment to be made. The contract and the market rate are the same. And the contract rate is referring back to this 8%, right? 8%. So
And the market rate is just coming from just what bonds are currently issuing, what rate they're currently issuing.
yeah, because each bond usually is graded. You know, may have A, B, C type, triple A, double A type bonds, and so they're all graded. And within those gradings, because the grading is based usually on the financial uh, stability of the company or the government entity. The more, it's almost like a
Like
FICO score.
annuities. I
No, it's
know
like
they
a
break.
personal FICO score, right? Like if I go in with at 800 of rating to an issuer, they're going to give me a lower interest rate, right? Because me as a buyer or a debtor is more probable to pay my debt off than somebody else that has, let's say, a 600 score. If they have a 600 FICO score, they're less likely to pay that loan off correctly or on time, and so they're going to have a higher interest rate. So it's very similar in the sense of bonds, but just the other way around. You're going to get a better interest rate if you're more stable and more secure on your bond, then, which really means you get a lower interest rate. You're able to set a lower interest rate. And if you're less secure as a company, your bond is going to have to be higher. Your contract rate is going to have to be higher. So that's where this issuing a discount versus a premium comes into play. It all depends on what the market's willing to do for a particular series of, or particular series of bonds. So in this case, a par value of $100,000, 8%, right? This is the contract. And they walk you through how that looks, very similar to what we just went through in the prior example, right? $16,000 paid over a 2-year period of time. But it was sold at a discount. So in reality, the company in this case, so if it was sold at a discount, that means that the contract rate was less than the market, right? Discount. So in that case, in reality, the company only received 96.4 instead of $100,000 because it was sold at a discount. And so when they go to record it, they're going to record the cash received at 96.4. That's the discount from the contract value, and they have to record that as an discount on bonds payable. Set that up as a This is actually an expense. So effectively, the company had to pay $3,600 in order to issue a $100,000 bond. And so when they did that, they still have to pay back the lender, or the individual, or it could be other companies. They have to pay them back $100,000, but they're only getting 96.4 at the beginning. So that's the first entry, right? This is the discount. Then they have to amortize that expense over time. Well, actually, they're setting this up as a contra. Okay, they're setting this up as a contra liability to the bond. They're not expensing it immediately. So I'll take this back. This is a contra liability. So initially, this is all a balance sheet related item. And then when they go to actually make the payments, they're going to make the $4,000 payment plus the discount. And so the actual expense, if you will, for that total transaction is 19.6, which is the 16,000 plus the 36. So the bond interest expense is the combination of these two. Because remember, last time we had $4,000 as the bond interest, but now we had to add the 1/4 of the $3,600, so it ends up being an additional $900, right? And so they just do the calculation here. Total 19.6 divided by 4 gives you this. And then you have to break it out. 4,000 goes out in cash to the bond holder, and $900 is relieved from the liability, the contra liability that's here.
Okay, so just so I understand, we're taking any discount, dividing it out and adding it on to what was already there.
The expense, yeah.
Yeah.
So this 4,000 is the amount that's going out in cash to the bond holder, but the rest of it, the other $900, is the amount of the discount that we're recognizing as an expense in the current period.
Oh, just the discount portion. Okay.
Yeah, just the discount. So that's why you have this bond interest expense is a combination of the two,
Okay.
because the amount of stated interest plus a portion of the discount for that period. Okay. So this walks you through what that looks like. You initially set up the bond payable, pay it out, right? But you're setting up the discount on bonds payable, which is the contra to the bonds payable, right? And then over time, you're relieving that, or you're reducing it, amortizing it over time, and expensing it. Now, a premium is just the opposite, but we'll get to that in just a second. This is just the discount side. Let's see where they go to the premium. So the premium, they're going to get more money, and they're going to amortize that over time. So I wish they would have kept this at the same numbers, but just different. But this is a 12%, 12% 2-year, yeah, paid every semi-annually. So similar concept, but instead of 8%, they've used 12% here. All right. So they received, because it was at a premium, they received 103,600, but they're only going to pay back $100,000. And that's because the contract rate is greater than the market rate. So they're going to get more money effectively up front. So this is the money you get in. The premium that's paid is the $3,600. Not really paid, but it's recognized. Well, it is paid $3,600 because this is the premium. $3,600 is the premium, and then this is the amount that has to be paid back, $100,000. So in this case, instead of the discount being added to the interest, the discount, actually the premium, is being reduced from the interest on every single payment that goes out. Right. So before it was the interest amount plus plus the
Mhm.
discount, and this is the interest amount minus the
Minus.
premium, right? Gets you to the net amount that's recognized each 6 months as the interest amount. And so they're still only paying out $6,000. This is the only obligations to pay out the interest. But the interest actually recognized for the period is less by the amount that's being amortized over the premium that's being amortized over the 4 different payments. Right. So before we saw the discount over here, and now we're seeing the premium over here on the credit side, on the debit side. So same trial on T account, you have the $100,000 come in, and the $100,000 go back out. But instead of it being a contra account, it's a payable premium on the bonds payable, and they set it up as $3,600 because that's the full amount that was received. But then they're amortizing that over a period of time, so this becomes zero. And you've reduced your net interest expense by your total interest expense by the 3,600, which gets you back to here. $2,400 total interest expense paid out minus the premium received equals the net amount of interest actually incurred by the company. And it walks you through just kind of a view of that as well. So that's really maybe some of the key concepts on the difference between the discount and the premium. The simple one is just the par value. Contract equals market value.
Mhm.
You know, you record it at the par value and coming in, and you record it basically backwards going back out, plus the interest that's incurred on the whatever time frame is there. And then you just have to worry about whether or not it's a premium or a discount. And the biggest thing they're going to do is they're going to test you on this right here first. What is the difference between a premium and a discount? Right. And then you'll have to go through a scenario. And they should tell you very similar to this, what happened, right? Where did they say this? Right here. So they'll give you an example very similar to this, right? So FILA issues a bond at 100,000 par value this will be the trick. They'll say par value, which really means contract value, at 8% rate, right? Paid semi-annually. This is the easy part. And then they'll say it sells, right? So they issued it. This is the contract. That's effectively the issuance. And then it's sold either at a discount or a premium, and they'll tell you what that is. Now, they may tell you is not, you know, they may just say these bonds sell at 96.4 or something like that, or 96.4% of par value. They'll give you some portion of this, and they'll ask you, is that a premium or is that a discount? Something like that, right? And so because the value received is less than the value issued, that's a discount. If the value received is greater than the value issued, it's a premium. So then you know kind of how to treat the transactions, right? But this will be the key component, being able to read through this and determining whether it's a discount or a premium. And then doing the calculations, right? So if it's 100,000 at 8%, you know, you're paying out 8,000 per year, and it's twice a year. So you have to divide that by 2 when you do the journal entry, or divide it by 4 if you calculate the full amount for the 2 years. But I would keep it simple. Figure out the annual rate and then divide it by and figure out how many times it gets paid out per year and divide it by that number. Sometimes you know, this is semi-annual, could be quarterly, could be monthly. So you just have to understand if it's, you know, if it's monthly, then you take that 8% divided by 12, and that's your monthly journal entry. Which then means you have to take the discount and divide it by 12, and that's your monthly, you know, add or subtract if it's a premium or discount. Okay. Any other questions, Carol? Anything?
No, I think that helped though to help me understand what was going on here. So that's great.
Okay. Let's see if there was anything else. Bonds, premium discount, premium installment notes are pretty simple. I don't remember if they have this in here. Let's check. Bond fat. Any thoughts on what the advantages or disadvantages of bond financing are?
Well, just what I read in the book. I just haven't done much with bonds, so it was kind of one of those things I have to just I'm going to probably need to reread it again.
Yeah, well, generally, this is bonds are issued because you don't want to dilute your ownership base, your stockholder interests, and so
Okay.
and it's usually because you only need it for a short period of time as well, right? Whereas an investment in the company is a long-term issue. Issuing of a bond is a short-term issue, and it doesn't
Okay.
dilute the shareholders' interest in the company. The other thing is it's a very fixed amount. And whereas the cost of equity sometimes is much higher than well, almost always much higher than the cost of a bond, right? So in these cases, they were showing maybe the rate of return on a bond, like the interest rate is 8 to 10%. It could even be lower than that, right? It could be 5 or 6%. Whereas the rate expected by a stockholder is much higher than that. It could be 20 to 30%, right? So if your company isn't performing at a high rate, your stock price might be impacted by that. And therefore, your ability to issue stock in the future may be jeopardized, right? So you have to make sure that your stockholders are happy with the overall performance and feeling like they're getting a return on their investment, even though it may just be a stock price increase, but also may also be a result of dividends that they're getting, a combination of the two, right? So the rate of return is much higher. So usually short term versus long term, dilution in stockholder investments, and then also the rate of return is much better, or the interest, if you will, the expense to the organization for a bond versus a stockholder
Much lower.
Yeah. So that's what those are some of the key ones I would point out. Current debt ratio. Okay, debt to equity ratio is pretty easy to calculate. This is total liabilities divided by total equity after costs. Okay, I didn't do the after tax effect. Let's see where we're at. Right here. Yeah, I was trying to see if they were going to make you do a amortization schedule, but I don't think so.
Well, there's a lot of information to cover.
Yeah.
With every chapter. So I figured this might be heavier just because they're not really testing it on us till the exam, but there's still a lot to cover in all the chapters. So
yeah, there's a lot of all the prior chapters that they're going to cover mostly, and this is going to be pretty tight in terms of what they're trying to test you on. Debt to equity, that's pretty straightforward. Just what it says, debt divided by equity. I think that should be pretty easy to calculate. So did they even deal with the after tax on here? Installment, payment, mortgage notes. No, they did not deal with issuing bonds at a premium. Straight line, they did not deal with the tax consequences. Issuing discount, straight line, no tax. I doubt there's going to be a tax issue in here. Let's go to the cheat sheet, see if it's in here. maturity discount premium, bond, long-term notes. Yeah, there's no tax consequences in this one.
Oh, good.
I mean, just in case it comes up, you just have to think of after tax being, in this case, let me just do a little Excel file as an example. Okay, so let's see if I can find it right there. Okay, so if you paid interest of $4,800, right? Is $4,800. That's an expense, which means it reduces your income, right? Let's see if I said revenue, is zero, or zero, then my net income, because I just have interest, is going to be my revenue minus my expense. So it's a negative. So effectively, I don't owe any taxes because this is net income before taxes. Okay, this is a just in case scenario. Taxes, and let's say it's 15%. So if I do this, but it's only if it's greater than zero, right? So it'd be more like if equals if this is greater than zero, then take that amount and calculate the interest and the taxes. Otherwise, do zero. So this is basically a little logic. So my taxes are zero, right? But let's say my revenue is $10,000. Well, my before my I forgot to do this net income after. Okay, so let's go back here. Right, so net income after taxes is $4,800 in this scenario because I have no revenue. Even if I had this exact same revenue as I had interest, I'd still have no taxes due. But the minute I have taxes due, let's say it's 500, so my net income was 5,000. So let's say I had net income of $200. Well, my taxes are really only on my net income, not because my interest is shielded a portion of the taxes. So it's providing a benefit in terms of overall tax liability. And so a way of looking at that is at what point the calculation is effectively 4,800 divided by the 15%, not one minus the tax rate. That's at the point where my revenue is sufficiently large enough that the tax rate starts to equate to the interest the tax benefit from the interest associated with it. And so it's giving you essentially a 15% boost. So if I do this another way, that times the tax rate, this is the amount of income that the interest is shielding from taxes. Maybe that's a simpler way of looking at it. Right. So the interest that you've recorded for the period times the tax rate is the net income that you don't have to pay. That is the taxes that you don't have to pay because of the interest rate or the interest. Otherwise, this 847 would be, if I take this to zero, it should be 1567, 5647, and then 847. Yeah, you get a $720 benefit, right? So if I take this to 0, it's 847. 4,800 gives me the other number. So that's the benefit right there. That's the
Why do
easiest way.
they in Excel, I've run into this several times when you're calculating that rate, you put the one minus, is it like a $1 or one minus a percentage to come up with? I'm just trying to figure out why they usually put that one minus in parentheses. I've been told to do it, but I've never really, I don't know why they do the one minus when you do those calcs.
Yeah, that's a great question. So I did this, didn't I? I took
Yeah.
this divided by 1 minus the rate to give me the coverage, essentially. Why is that? That's a great question. I have to think through that
You've
for a
probably
second.
done it for so long, you don't think about it
I
anymore.
don't even think about it. So
Yeah.
is 1 minus the rate, because 1 minus the rate is 85%, right?
And
So
that's what it does. So
yeah,
it's just a way of doing it backwards, I think.
yeah, yeah.
Anyway, I'm just curious because I see that and then it's like I forget about that. And everybody said, well, if you want the right answer, just put the one minus. And I was like, okay, I want the right answer, so I'll put the one minus. But that's all I knew when I was just putting the one minus.
Yeah. Yeah. So, you notice this 720 is the same as essentially this right here, 720, right?
Hmm.
Um, and that's what the coverage is at the top line. Um, yeah.
Well, anyway, I
Yeah.
can Google it.
That's a great question. You're right. I've done it so long, I don't even think about it.
Think
I
about
don't
it.
even, I don't even remember why. I just know that the math all works. And so,
Yeah.
um, so the easiest way to think about this is just, this way. This, how much taxes am I saving because I'm incurring some interest? Not that
Hmm.
that's a good thing, but it just means that it's really an offset, right? My net interest amount is the difference between these two. Net of interest is 4,080. So I'm not really paying 8%. I'm paying less than 8%, right? Or whatever the number ends up being. I'm paying more like, if this was a period of time, right? So this was, let's see, if the note was $100,000 and this was the amount oops, no, what am I trying to do? I'm trying to do plus, yeah, this divided by this times 2. So effectively, my interest rate is 9.6% annualized percent. The reality is, oh, come on, instead of 9.6%, I am actually only paying as an effective interest rate divided by that times 2, right? After taxes, I'm effectively paying 8.2%.
Hmm.
So this is the impact of, the tax on the interest on bonds or the interest on anything. Um, usually look at it on an after-tax basis, and so this is the impact. So the easiest way to do this is like I just did it here. You know what the interest rate is, you know what your tax rate is, calculate the benefit in terms of taxes, figure out your net amount, take that net amount divided by the principal and annualize it, whatever that happens to be. In this case, it's just doubling it. And that's,
Tricky
yeah,
stuff.
a little tricky, but voila, you have a video to go back and see how
That's right.
crazy um, uh, instructors do it.
Well, it's just seeing how your brain's working. I
Yes.
mean, which way you go.
Yeah, and I go all sorts of ways. It just kind of depends on what comes first in my mind, and
Yeah.
it's never really I don't know, foreseeable what I'm going to do. So but it's a couple different ways of looking at it.
All right.
But that's if it comes up. And since it is on here, I'm a little concerned that it might after tax cost of bond financing, right? So you just have to think through, okay, what's the interest rate? What's the interest amount? What's the tax rate? And then figure out the tax on the interest, net it out, and then figure out and recalculate the interest rate on the principal. And we went through that. And then the rest is all prior information. Okay, any other questions, Carol, that I can help out with?
Not at this time. I appreciate your time.
Well, I'm sure the students appreciate you asking the questions because otherwise I would just say this is all easy and it's all right there in the book.
Well, and I agree that a lot of it is in the book, but sometimes I miss some of the little details. I read past them or over them or miss them. And so it's good to have them pointed out.
Yeah.
And I like the class hours because I feel like I'm actually have a teacher and I'm not just totally everything online. Some classes I take and everything's a YouTube video. And
yeah.
So I appreciate a live person to interact with occasionally. So thank you very much. It's
absolutely
been helpful all semester. So.
Good. Well, good.
All right.
I'm glad. Well, you have a great rest of the semester and let me know if you have any questions.
Okay. Thanks so much.
Take care. Bye.
Bye.